This is our Forex blog for March 23rd, 2012. And like we do most days, we want to buy the strongest currencies versus the weak and sell the weakest versus the strong. This is just one small component of the different tools and systems that we teach in our Forex classes, so make sure to watch as many of those as you can. This is the easiest way for new traders and even experienced traders to find good trades throughout the day. Basically, we statistically compare every currency to every other one using the real-time strength and weakness, the daily trend, the weekly trend, and monthly trend. When all three line up, you tend to have trends that can last an hour to 3 hours, like you can see here in the dollar right here. The top one's made up of 5 of our best tools. 3 of them measure direction, in this case that the dollar's moving versus all the rest, and 2 of them measure the intensity of the direction, bar by bar intensity, and also the last 30 to 45 minute intensity. We average those together into one smooth reading. So basically, one of the best patterns to look for is incredible strength like this, followed by less weakness. And when all the time frames are up, that trend's very likely to continue. And you can actually see that here at 6:30. It continues for about an hour, and you have a little bit of weakness, an hour of strength, and so forth. And so during that weakness, if you see very little weakness like this in comparison to the previous momentum up, then the previous momentum up trend is likely to continue, especially like in the euro here when the daily, weekly, monthly trend are all up. Same thing with the Swiss. Strength for a couple hours followed by a half an hour of weakness, a little bit of strength for half an hour, 10 minutes of weakness. That strength continues, not with the most intensity, but a few of the bars have incredible intensity. Whenever it's at or above the 80 level, it's strong. And you have a nice hour trend here up from about 6:30 to 7:30. So what could you have traded this Swiss on, for example? The Swiss is not one that we leave running compared to, for example, the Australian, but the Australian was weak at that time. So let's just say coming up to 8 o'clock here when there's a little bit of weakness, it's pretty safe to assume that the Swiss will resume its strong trend. So coming up to 8 o'clock would be one of those times where you could look for sells. And we have basically 2 methods. One is a pullback, which you can see here. You kind of visualize, or even if you want to, draw a trend line underneath the bar's low, and when it breaks down right there, you go short with your stop just simply a pip or 2 over the swing high. And a lot of times we're not even risking 10 pips. Now in this case, that trend didn't really continue, but it did go 10, 15 pips away and went sideways. Plenty of opportunity to make money on that trade. And you can see earlier in the day, there was a similar pattern. Extreme weakness, very little strength. That trend is very likely to continue, let's say around 4 to go down. You watch this currency here, and at 4 o'clock, you might have gone short here, lost 10 pips, short again here, and most of the time when you have a weak currency like this, it's going to work its way down to the fib target. So you could just put your stop over those swings highs, and kind of when it goes sideways and makes slightly lower lows, and it went right down to that fib target. In this case, you made about 20 pips while risking 10 pips. It wasn't the most volatile currency move in the world. But you have the same similar pattern here in the CAD. Very weak Canadian dollar. Some of the stronger ones, again, were the Swiss and the Euro. So we'll be looking to buy the EURCAD. Let's hit the minus key and scroll back a little bit. And you can also use these tools. This is the FX Trend Pro on the individual chart. This is a currency I don't typically leave running, so let me just add this to the chart. FX Trend Pro. And you can see that the momentum was to the upside. Now, because we compare every currency to every other one, the EURCAD is just kind of going sideways, but other Euro currencies are going up and going up with incredible intensity, and the CADs are falling. So most of the time when you see this kind of pattern, it's only a matter of time before it breaks out. Here you have a nice little multi-hour sideways range pattern, and when it breaks out, it's just off to the races. If you got out of it right here, it went up 40 pips. If you missed that first nice move, you basically are buying this pullback here. And the farther up it goes, the more likely the first fib target is to be the place to get out, as you can see right here. If you want to get out of that trade right there and then buy the next pullback, you're certainly, it's a wise thing to do. This is about a 20 pip pullback right here. And after, again, the more it goes up, the less likely it is to make a tremendously bigger move. You draw your fibs on there and notice it went a few pips underneath that level. But if you had bought this breakout right here at 49 with your stop underneath the lows here, and you got out of this trade at 74. You made about 25 pips while risking 10. Now the euro was strong, the CAD was weak, so was the Australian. The euro Australian also is a very high probability one to be buying until later in the day when the euro lost its strength and the Australian gained some. You might have got into this trade right here and it just kind of went nowhere. I usually use a 30-minute time stop. If it goes up just a little bit and goes sideways, I tend to exit half the trade and I'll let the trailing stop get out of the second half. I really want to wait and see some momentum come in here before getting into trades. And keep in mind, you only need 10 pips a day to double your account every 2 months. So 10 pips a day is 50 a week, 200 a month. And when you see a big move up like that with some momentum, typically it's a pretty high probability trade to buy the pullback. So you bought this little pullback right here. Didn't really go too far. Again, always watch the previous swing lows and highs. When the currency can't break the lows, that's pretty bullish. You get in again. It goes up and it's kind of going sideways here, and you can see the statistical momentum is gone. So if you had taken this trade here at, let's say, 37, went all the way up to 53, more than enough to take your 10 pips on there. And as you watch the currency meter, later in the day, around 10:30 right here, the Australian starts to have a lot of strength. And a little bit before that, from 9 to 10, the euro's, getting a little bit of weakness here. So you might not have taken that 10 o'clock trade in the euro. As you look at this chart right here, the euro against most currencies was weak, but against the Australian it was less weak because the Australian was more weak than the weak euro was. But on the way up here, you just don't see the momentum. If you get into any trades and you don't see the previous explosive momentum where it goes above the 80 level, come back in, or if it does come back in for a bar or two and then kind of drops off like that, you want to exit your trade. For example, we have weakness here in the dollar here from 3 to 5. Most of the time frames are pointing to the downside, or at least it's not incredibly strong. So the euro dollar is a good one to be buying from 3 to 5. And you can just simply use our intelligent trailing stop to get you in and out of trades, especially when you put it on a range chart. A range chart, instead of time, uses a certain number of pips per bar. This is a 6 pips per bar range chart. And when you see this breakout right here, notice how well our trailing stop does. In fact, a lot of traders use these for entry and exit. When the price is above the hourly, it's more likely to go up. You bought this right here at 02, out at 41 for a nice 39 pip win. You get back in here again at 45, and it got you out up here at 69 for over 20 pips. So, and usually when a currency is above the white 2.0 containment band, it's usually kind of run out of steam. And here you have a nice little false breakout. It broke from underneath to above the previous day's high. Can't really, there's a lot of volatility. It's going up and down 6 pips, 6 pips, 6 pips frequently. And then when it breaks down right here, it's a nice high probability counter trend trade. You're risking less than 10 pips, short at 83, out of this trade at 55 for almost a 30 pip win. And really that's the key to trading, small losses and bigger wins. You're going to have some 5, 10, 15 pip wins, but you're also going to catch some 20 to 50 pip wins as well.